Good afternoon, everyone. Welcome to the Bank's Inflation Report press conference. On my far right, I have Ben Broadbent, Deputy Governor for Monetary Policy. On my left, Dave Ramsden, Deputy Governor for Markets and Banking. And on my immediate right, the Governor, Mark Carney.
Great. Thank you very much, Mike. Good afternoon, everyone. Since May, global trade tensions have intensified, global activity has remained soft, and the perceived likelihood of a no-deal Brexit has increased significantly. These developments have led to a substantial declines in market interest rates and a marked depreciation of sterling. UK financial conditions have loosened materially as a result, and they can be expected to remain volatile as the prospects for Brexit and therefore the UK economy develop. The UK economic outlook will continue to hinge on the nature of EU withdrawal, and the appropriate path for monetary policy will depend on the balance of its effects on demand, supply, and the exchange rate. As a consequence, the monetary policy response to Brexit will not be automatic, and it could be in either direction. The committee will always act to achieve the 2% inflation target in a sustainable manner. Starting with developments in the global outlook, with the ink barely dry on our May inflation report, the US-China trade dispute deepened. And more generally, the rationales for protectionism have broadened, increasing the risk that it could prove more pervasive, persistent, and damaging than previously expected. There are already signs that trade actions are having larger effects than previously anticipated on global business confidence and investment spending. For example, the global manufacturing PMI fell to its lowest level since October 2012. The latest indications and indicators suggest that global growth is holding steady rather than picking up as the MPC had expected 3 months ago. The quality of that growth has also deteriorated, with the growth rate of business investment in the G7 cut almost in half since its peak in late 2017. Global price pressures remain subdued, with headline and core inflation below target in all major advanced economies. In response to the softer outlooks for global demand and inflation, the expected paths of policy interest rates in advanced economies have shifted sharply lower. Expectations of easier monetary policy are supporting global financial conditions in turn. U.S. 10-year yields are near 2-year lows, 10-year gilt yields are at their lowest in 3 years, and German 10-year Bund yields are their lowest ever. Around $14 trillion of global investment-grade debt is now trading at negative yields. In the MPC's latest projections, these more accommodative financial conditions offset the drags from trade headwinds, although global growth is now expected to return to potential rates more slowly than in May. UK financial conditions have also loosened since May in response to both global developments and the growing weight financial market participants are placing on the possibility of no deal. Sterling's now 6% lower than at the time of the May report. UK-focused equity prices have fallen by about 5%, and gilt yields have dropped by around half a percentage point. The market yield curve underlying the MPC's latest projections falls to 0.5% over the coming year and ends the forecast period at 0.6%, or around 40 basis points lower than in the May forecast. Turning to the UK outlook, as well as their impact on financial markets, Brexit developments are making UK GDP growth more volatile than usual owing to stock building and auto plant shutdowns. Looking through these temporary factors, the underlying pace of growth has slowed to below potential rates as a result of a weaker global demand and more entrenched uncertainty about Brexit amongst UK companies. Only 1 in 6 respondents to the bank's decision-maker panel now expects the future relationship with the EU to be resolved this year, down from almost half in January. 1/3 of our agents' business contacts report being more uncertain about the economic outlook now than they were ahead of the extension of Article 50 in April, while only 1 in 10 have become more certain. These developments have already led to marked weakness in UK business investment since the referendum. Investment intentions point to further contractions in the second quarter and third quarter of this year, and the MPC now expects business investment to pick up more slowly over the course of the next year. By contrast, the labor market remains tight, with employment at record highs and unemployment at 44-year lows, and pay growth strengthening as a result. Supported by the resilient labor market, households' confidence in their personal financial conditions is holding up, with spending rising broadly in line with real incomes. To be clear, UK households are acting prudently. This is no debt-fueled consumption boom, and households' concern about the general economic situation continue to restrain housing market activity. Overall, the MPC expects underlying GDP growth to remain subdued over the course of the coming year, with Brexit-related uncertainties and softer external environment both weighing on spending. As a consequence, a margin of excess supply persists over the next year. UK inflation is currently bang on our 2% target. Domestic inflationary pressures have strengthened as wage growth has picked up, with growth in unit labor costs currently around target consistent rates, although core services inflation remains somewhat subdued due to temporary factors. Headline inflation will probably dip around 0.5 percentage point below target in coming months, owing to cuts into energy bills, but core inflation should remain relatively stable at rates only a little below 2%. Looking forward, increased uncertainty about the outlook suggests that the UK economy could follow a wide range of paths over coming years, depending, most importantly, of course, on the nature of EU withdrawal. Consider, as financial markets increasingly have, the prospects for no deal. The bank has been working since the referendum to ensure that the financial system is ready for Brexit, whatever form it takes. In order to continue to serve their customers, whatever happens, UK banks are now both exceptionally well capitalized and highly liquid. Our contingency planning with domestic and EU authorities, our contingency planning with both domestic and EU authorities is mitigating possible risks to disruption of cross-border financial services. And most fundamentally, our institutional framework is robust. The bank has clear objectives, we have operational independence, all the necessary tools, and the needed resolve to deliver our monetary and financial stability remits. But financial stability is not the same as market stability. In the event of no deal, no transition Brexit, sterling would likely fall, the risk premiums on UK assets would rise, and volatility would spike higher. Similarly, preparations by governments and businesses for no deal are vital to reduce the potentially damaging transition costs to a WTO relationship with the EU. But those preparations cannot eliminate the fundamental economic adjustments to a new trading relationship that a no-deal Brexit would entail. In the event of no deal, it's probable that CPI inflation would rise and GDP growth would slow. For example, our agent surveys of businesses finds that most companies now report that they're largely ready for no deal. However, just a fifth describe themselves as fully ready, while 3/4 of respondents say they were, I quote, as ready as they can be. And despite greater preparedness, businesses still expect their output, employment, and investment to fall by about 1 to 3% over the next year in the event of no deal. When setting policy in the event of no deal, the committee's interest rate decision would need to balance the upward pressure on inflation, from the likely fall in sterling and any reduction in supply capacity, with the downward pressure on inflation from any reduction in demand. It's, of course, the government's intention to achieve an agreement with the EU. Therefore, as in previous reports, and consistent with our general approach to condition forecasts on government policy, the MPC continues to assume a smooth transition to the average of a range of possible outcomes for the UK's eventual trading relationship with the EU. In our latest projections, as details of the UK's future trade relationships gradually emerge, business investment recovers and household spending picks up, broadly in line with robust real income growth. Owing to much easier financial conditions, the acceleration in growth is stronger than we had projected in May. With potential supply growth expected to remain subdued, the pickup in GDP growth results in sharply rising excess demand, which reaches 1.75% of GDP by the end of the forecast period, materially higher than in May. This pushes up CPI inflation such that it's well above target and still rising at the end of the forecast period. Now, the MPC's projections are materially affected by the inconsistency between the asset prices on which they are conditioned. Those asset prices take into account the full range of Brexit outcomes, including the substantial weight market participants are placing on the possibility of no deal. And that's inconsistent with the committee's assumption of a smooth transition to a Brexit deal, which by definition does not take into account the possibility of no deal. If, as assumed, Brexit proceeds smoothly to some form of deal, market interest rates would probably rise and sterling would probably appreciate. Consistent with the stylized sensitivities that we've outlined in a box in today's report, the committee judges that gradual and limited interest rate increases would be appropriate to return inflation sustainably to the 2% target in the case of a transition to a Brexit deal and some recovery in global growth. At this meeting, the MPC judged that the current stance of monetary policy remains appropriate. Now, to conclude, profound uncertainties over the future of the global trading system and the form that Brexit will take are weighing on UK economic performance. Until those uncertainties are resolved, shifting perceptions of them will drive volatility in market interest rates, in equity prices, and in currency values. Monetary policy cannot offset the real effects of these fundamental drivers of jobs, growth, and prosperity. But monetary policy can help smooth the adjustment of the economy to these shocks. And to that end, the people of the United Kingdom can be confident that the MPC will take all appropriate measures to support jobs and activity consistent with achieving the 2% inflation target during these exceptional times. And with that, Dave, Ben, and I would be pleased to take your questions.
Okay, please give us your name and organisation when ask a question. Wait for the mics to reach you, and please one question first time around. I'll take Joel and then Jamala first.
Joel Hills from ITV News. Governor, the Bank of England assumes Brexit will be smooth. The markets are increasingly betting it will be anything but. Michael Gove assumes no deal will happen. Boris Johnson says the chances of no deal are 1,000,000 to 1. In the interests of transparency, Governor, yes, and for the people of the UK, what is the committee's view? How likely is no deal at the end of October?
Well, first thing, it is government policy to pursue a deal. I think the Prime Minister has been absolutely clear about that. What Mr. Gove was referring to was the assumption of no deal for the purpose of Brexit contingency planning. Absolutely necessary. Assumption of no deal has the consequence of some of the announcements we've seen today of additional spending, or at least the provision of monies for additional spending that appear to be necessary to prepare for no deal. Look, the Financial Policy Committee of the Bank of England has assumed the possibility of no deal since the day after the referendum, which is why we've been preparing the financial sector to be ready for no deal, and that the core of the financial sector is ready for no deal. But that's different, preparing for a contingency, and the country has to be prepared for that contingency. Financial sector is prepared for that contingency. A contingency is different than what's most likely, and all I can do is quote the Prime Minister speaking earlier this week, where he said, "We're not aiming for no deal. We don't think that's where we'll end up." And the decisions on whether or not there is a deal are decisions for government in negotiations with their European partners.
That's the Prime Minister's view, but what's yours, Governor?
Can you just pass them to Jamala? We can come back. We've got time. Thank you.
I'm not going to ask what your view is. Giovanna Versace from CNBC. It seems to me that you're still guiding towards rate hikes, and indeed today you have your inflation CPI over the forecast horizon at 2.4%. even under your stylized changes in asset
Yeah.
prices, so that's box 6, you still got 2.1%. So you're still implying rate hikes. Now, what is the value of providing that forward guidance in an environment where the market is pricing in rate cuts in 2020 and placing a higher value on the political risk than you are? So essentially, you're guiding the markets towards an outcome that the markets don't necessarily believe in, the assumptions that you're relying on.
Yeah. Well, what the market is doing, as the market always will, is taking into account all possible outcomes. It's relatively unusual. It's not totally unusual, but it's relatively unusual to be in a situation where you have quite binary outcomes, such as the country faces between the possibility of a deal and a smooth transition to some form of deep trading relationship with the European Union, to no deal and an instant adjustment to a WTO trading relationship, which is a very different thing. Now, the market is, as you know, weighting across all those outcomes and increasingly has been putting greater weight on the latter, on the no deal possibility. Not the majority weight, but greater weight on that. We look at what's most likely. We look at government policy. We also speak to the people in the country. And there's two messages. There is a clean, clear message around, in the event of moving towards a deal, we think that the way the economy will perform will be consistent with some modest adjustment upwards in interest rates over that period of time. Okay? And it's important that households and businesses understand that. And actually, there's reporting in this report of something called the NMG survey of thousands of people across the country. That's what they expect. Okay? It is more complicated in the event of no deal. And it's more complicated in the event of no deal because it is not as simple as saying that in the event of no deal, there's just one path that monetary policy could take, because no deal would very unusually, for an economic shock, be an instantaneous shock, not just to demand, which is what everybody is used to seeing, but a shock to supply. There will be supply capacity in this economy that will become uneconomic. Now, the degree to which that happens will partly be influenced by no deal preparations, but not totally eliminated, as I just said, by those no deal preparations, because the fundamental economic trading relationship has changed, and it will take some time for this economy, which is one of the most flexible economies in the world. Even this economy, it will take some time for it to adjust its supply capacity, which was oriented in export terms largely towards Europe, to be oriented in different directions. And that's why it is not as simple. I know you didn't ask this directly, but it's not as simple as just saying rates go one way in the event of a deal and they go another way in the event of no deal. That's why policy response is not automatic. So the value of giving the guidance on the still most likely scenario, it's become less dominant than previous, but the still most likely scenario is so households and businesses know where it's going, and quite frankly, markets know where it's going. And if you strip out their no deal probability weighting, it's basically where they expect it to. Thanks.
Edmund Faisal. Thanks. Thank you.
Ed Conway from Sky News. Governor, it's your last set of major forecasts ahead of that October deadline, and a lot of people will be looking towards you and towards the bank to try and get some sense of what to expect, how to prepare for a possible no-deal Brexit. So what's your advice to the person on the street? I mean, how do they prepare? What should they expect? What might this feel like from your perspective?
Well, let me reiterate that, again, we obviously don't speak for the government, but we listen to the government in terms of their stated policies, and it's still the stated aim of the government to have a deal. First point. But in terms of preparations, it is important to reinforce to people on the street, hopefully people also have homes to go to, but people on the street, that the financial system is ready for it. We have been preparing for this for years, both in terms of what we can do, but also the institutions themselves. But a no-deal situation, broad brush, is one in which sterling is likely to be lower. in which inflation is likely to be higher for a period of time, and the economy is likely to slow. Now, the degrees to which all of those happen vary on many factors, including, by the way, what no deal actually means, because one of the uncertainties in all of this is different people mean different things when they talk about no deal. When we do our contingency planning at the Bank of England, no deal means no deal. No deal means there's no side arrangements. No deal means that the trading relationship instantly goes to WTO tariffs and product standards, and then it has the associated economic effects. So in terms of households and businesses, look, I would say broadly this, which is that UK households, I said it a moment ago, are acting prudently. They're not borrowing a lot. They're spending out of their real income. They do have a very strong labor market going into this. Unemployment at a 44-year low. Real wages are growing the fastest since before the crisis, since 2008, and inflation's bang on target. So real incomes are growing, but households are not becoming overextended, and that's probably the right approach to take.
Faisal Islam, BBC. Just to clarify some of your answers to the previous questions, if there are people in Downing Street who think that if there's a no-deal Brexit, this institution will deploy a massive monetary stimulus, are they wrong?
It depends. It absolutely depends on the impact. First, what does no deal actually mean? Is it, as I just described to Ed, absolute overnight jump to WTO with no mitigating actors? That's the first question. Secondly, it depends on the impact, the degree of preparedness of border infrastructure, other infrastructure in the country. So how free, in this country and in Europe, obviously, because it's all interconnected. We could have a good day of imports into this country and putting stuff on ships, ferries to go across the channel, but if they don't come back, then, or they get held up there, then it will have knock-on effects. So it depends on the preparations, depends on the nature, and it also depends on how quickly the supply capacity of the economy adjusts. Because there's trade disruption in no deal, problems at ports, and then there is supply destruction. And that is activities that used to be economic as part of the single market that no longer are economic, and then those resources need to be redeployed. And we will have to take a judgment in that event about whether, on balance, the inflationary pressures, and there will be inflationary pressures in no deal because of the exchange rate, because of some of the tariffs that come in, because of some loss of supply, whether those inflationary pressures, whether we can look through those, extend the horizon, and provide support for the economy as it adjusts. Now, what we have said, and I've reiterated in my opening remarks, is we will do what we can in those circumstances to support jobs and activity, but there are limits to what we can do. Ultimately, this is about our best contribution is returning inflation sustainably to that 2% target. And it is an unusual circumstance to have a major supply shock, and that was not the case after the referendum. It was only a prospective supply shock, not an actual one. In no deal, it will be an actual one.
Okay, Phil and then Helia. That's it.
Yeah, Phil Aldrich at The Times. Gary Cohen's been on the radio this morning saying that he believed that no deal would be preferable economically to prolonged uncertainty because economies are more resilient than we tend to think they are. Interview with the BBC.
Who was it? Sorry.
Gary Cohen.
Never heard of him.
Is he right? Is he right?
Can you pass that on to Gary that I've never heard of?
Is he right? Is Gary Cohen right that no deal is preferable to endless, prolonged uncertainty?
No, he's wrong. The no deal as a crystallization of a bad economic outcome is not preferable to the possibility of a better economic outcome. And as we have said, since immediately following the referendum, that it is whatever outcome the country chooses, it is always preferable to have a transition to it. And I think that, again, that is consistent with the preferences, the aims of this government, and consistent certainly with the aims of businesses up and down the country. Again, this country is, if not the most flexible, one of the most flexible economies in the world, and it's supported by one of the strongest financial sectors in the world. But it is very difficult to change things overnight. And it's highly preferable, whatever choice is made, that there is some transition to it.
Get the mic to Helia just here, please. Thank you.
Helia Ebrahimi, Channel 4 News. Governor, you've given us stark warning about a no-deal Brexit, pound falling, inflation rising, growth slowing. Will the measures outlined by the new Chancellor cancel out these risks?
Well, obviously we don't speak for the Chancellor, and there have been some indications of a variety of measures that the government intends to take. There's also signaling that there will likely be some form of fiscal event in the course of the fall. It's obviously for the Treasury, for the Chancellor to specify that fiscal event and then to specify the measures. There's certainly the possibility, whatever the economic outcome path that the country is on, that fiscal policy will adjust. It could provide some support to the economy. And as the Bank of England, we will take that into account and we'll adjust our forecasts accordingly. But we can't, there has not been a new budget. There have not been specific measures put into place yet, and so we adjust once those actually happen.
Okay, can we get Larry over here and then Jason above him, please?
Larry Elliott of The Guardian. The MPC says that the interest rates in the event of a no-deal Brexit would not be automatic. They could go up as well as down. What you're not saying, though, is that the risks are symmetrical, are you? Right. I just wonder whether you think the risks are weighted towards a cut in interest rates in the event of a no-deal, or are they or in favour of an increase in interest rates? I mean, the markets certainly think there's more chance of a cut rather than a hike. I just wonder what you thought.
Yeah, it's an important question. I will say two things. First, that we have said that we will do what we can to support jobs and activity, subject to achieving the inflation target in a sustainable manner. That's what the committee has said. Individual members of the committee, myself included, have given their personal views on this in terms of the balance of risk and the balance of policy. But today, Dave, Ben, and myself are here speaking on behalf of the committee, and the committee has not given a collective view on that, so it wouldn't be appropriate for me. I just refer you back to my previous testimonies and other comments for my own personal view, but that's not a committee view, if you follow. Thanks.
Jason.
Hi, Jason Douglas from the Wall Street Journal. Nice to see Belfast on the cover of the inflation report, by the way.
Yeah, yes.
My question
is totally accidental.
My question is, could you give a sense of what you think no-deal Brexit would mean for the global economy? Is it likely to be, a bit of local difficulty relatively contained in Europe, or is it the kind of thing that could cause, what could be quite a severe shock to a global economy that does look quite fragile?
Yeah. Well, it would be an unwelcome development for a global economy. I know that as the perceived probabilities of this event shift around, my incoming calls and from fellow policymakers and interested observers certainly go up, and the intensity of discussions that are increase. There is obviously a lot of focus in terms of the interconnections between within the financial sector itself through financial markets, and I think there's an understanding, there's an appreciation of both the fact that, in our judgment and the judgment of European authorities, that the core of the system is ready, but also this distinction between being ready and resilient doesn't mean that markets don't move, and they don't move potentially quite sharply. And of course, when you get risk events, quite often correlations shift fairly substantially in ways that aren't anticipated and have knock-on effects. That's the first point, first few points. And then the last one, just to reinforce, is I think we all recognize that multilateralism is under some strain. The global trade system is being buffeted by a series of actions and threatened actions, and this would be part of that, at least part of that narrative. And it's not just a narrative; it's a reality that businesses are dealing with, and is creeping into the way businesses are thinking about how they organize themselves, particularly how they organize their supply chains. So it has effects, it would have effects beyond just, in my judgment, and I believe in the revealed preferences of fellow policymakers, beyond the GDP weighting, if you will, of the UK economy, which is considerable, but it's not the largest economy in the world.
Okay, Francine and Delphine, right above you. Yep.
Francine Lacqua, Bloomberg TV. Governor, how much of the slowdown in UK growth can actually be reversed by a smooth Brexit and by a resolution in the US-China trade deal?
So reversed, both of those would have a material, they would have a material impact on the outlook for the UK economy. There is a substantial, and it's detailed in the report graphically, it's graphically in both senses of the word, the investment shortfall that is developed in the UK, both relative to historic trends and relative to the major advanced economies. Some of that will not come back. The opportunity has been lost. But there is substantial dry powder. There's substantial opportunities. The financial sector is very strong, as I've been saying. So we would expect a sharper acceleration with not just a deal, but a clarity about the nature of that future relationship. And one of the things we've been picking up in the short term has been that this uncertainty about the future has become somewhat more entrenched in companies, so that the expectation, they're looking for clarity about that future relationship, not just a preservation of the current openness. Trade deals do take a long time to actually negotiate. We have to get from the no deal to deal, but then turning a deal into actual may take some time. U.S.-China, hugely important for the global economy, without question, not just because the two largest economies, but also because the nature of those negotiations have broadened not just to issues around a bilateral imbalance, but, if I can put it colloquially, the kind of rules of the road for trade in technology, trade and service, openness to foreign direct investment. So depending, obviously everyone hopes for a resolution, hopes for a deal, but the nature of the deal and the depth and breadth of that deal, if and when it comes, will send a big signal about the future of global trading relationship, and therefore for the UK would make a material difference to the outlook, which is one of the reasons why we've mentioned it.
Delphine Strauss at the FT. Coming back to domestic policy, Number 10 says that the policies it's planning to set out are aimed at putting rocket boosters under the economy. Do you think a big boost to demand is what's needed right now?
Well, the economy is a margin of excess supply is opening up in the economy. In our forecast, it quickly is used up in the event of progress towards a deal. And that's partly because monetary policy and overall financial conditions, in our judgment, are highly accommodative. So once some of that uncertainty starts to dissipate, there's an acceleration of the economy and move. Now, that's not the, again, the government speaks for itself, but there are multiple reasons why there might be greater spending. It can be for social services and protection. It can be to boost productivity through infrastructure and other spending. It can be for no-deal planning, as was announced today. And it can also be for contingencies in the event that the economy is weaker because of the nature of the negotiations or the adjustment to the EU relationship. And in that last event, or in any of those events, what we do, obviously, Delphine, is we take into account what the government decides, and then we can be pretty nimble and quick in adjusting policy in either direction accordingly.
Okay, Tim, right in the corner there.
Tim Wallace at the Telegraph. Governor, not quite everything's about Brexit. You've mentioned the global economy slowing down and the effect that's having on the UK. We've seen the Fed ease policy, the ECB open the door to more easing. Were you tempted to join them? Did you consider joining them to form a sort of united front in supporting the global economy?
No, look, the situations are quite different between ourselves. I mean, if the UK and Europe, there has been a fair bit of job growth in Europe, but the growth in wages and the growth in unit labor costs has been much stronger in the United Kingdom. And the headline figures, whether it's from unemployment, unemployment relative to where we see the natural rate, participation rate, private sector wage growth, all of those are stronger here. Core inflation is just below target here. It's around 1% in Europe. So there are pretty substantial differences in the position between that the ECB is facing and what we're facing here. And then with respect to the United States, I'll state the obvious, but sometimes it's good to state the obvious. The Fed was on a long hiking cycle. They had tightened policy, and they are adjusting from that. And I'll just refer to the comments that they released yesterday in Chair Powell's press conference for the to situate the rationale for that. But they're from a position where they had tightened policy, again, where they're operating with a very tight labor market. So we're in between the two. On top of that, we face, as we've said in the report, we have an economy that could face or that could travel down multiple paths, quite different paths, depending, obviously, most importantly, on the relationship with the EU. At this point in time, inflation's bang on target, labor market's tight, domestic inflationary pressures are firming, and again, and I'll stop with this, the intention of the government, the expressed preference of the government is to pursue a deal, and in that world, there would be some eventual limited and gradual tightening of policy. The judgment of the committee, and I very much shared that, was not easing policy or tightening policy didn't make sense. Keeping policy where it was did.
David and then Anna.
Thank you. David Goodman, Bloomberg News. Governor, given the next inflation report comes after the Brexit deadline, the first time we hear your detailed forecast for a no deal could be after that scenario has come to pass. Does the bank have a responsibility to the UK people to act sooner than this? And would you consider updating your forecast before November if government policy changes?
Our first and foremost, our responsibility is to make sure the system is ready for no deal. We've done that, and we'll continue to do that. It's not we're done and we're not looking at it, but we'll continue to monitor and take additional steps as necessary. We have been asked to update our worst case scenario, disorderly Brexit scenario, which the FPC has used to capitalize banks and assess the readiness of the system. And so we will deliver an updated version of that, obviously in response to the request of the TSC for when they reconvene in September, I guess. Look, we will respond to the circumstances as they change. Ultimately, what matters is that we are deploying monetary policy in a way that's consistent with achieving the inflation target, returning inflation to target if it moves away in a sustainable fashion, and in doing so supporting the economy while we do. And we don't need a full forecast in order to make those decisions. Thank you.
Anna Isaac, Wall Street Journal. Could I ask the Governor, he's made a very important point to the population of the UK, that the financial system is set so that it won't amplify, ideally not amplify the shock of a no-deal Brexit. Could I ask what contingency plans are in place to support the pound in the event that there's a market disruption as a result of a very sharp decline in its value?
Well, I think, first, it is highly, highly unlikely. That's the first thing to recognize. There will be volatility in asset prices as the probabilities around a deal or no deal shift, without question. We saw probably the most extreme version of this type of shock with the referendum, when the market was heavily positioned in one direction. The betting odds for all the utility were a 10 or 15% probability at 10 o'clock at night after the polls had closed, which gives you a sense of how much positioning was, and the extent to which one should take with a certain grain of salt these indicators of probabilities. And heavy volumes, big moves in sterling, but the markets functioned well. Now, you would expect us to take appropriate measures, or be ready to take appropriate measures to ensure that that is the case. But it's highly, highly unlikely. And what one wants when you have a big economic shock, and we've learned this and we are firm believers in it, is that markets adjust. And part of the shock absorbing function here would be a change in the value of sterling, market interest rates, and equities. And it's that belief in markets, that belief in the values and the institutional structure that's here, including, and this is a key point, which goes back to the policy response in the event of no deal, including a commitment to the inflation target, sustainable return to the inflation target, that also helps limit the scale of these moves. Thanks.
There's a few still haven't asked questions yet. Anyone who hasn't come in want to ask anything? Or if not, we've got time for a couple of extras. Okay, well, let's take Faisal Al-Halia then, and then we can wrap it up.
Governor, how will the sharp fall in sterling feed through into inflation? Is the quantum big enough to, for example, lead to real wages falling again?
Okay. Well, maybe why don't I ask Ben to just say a word or two about, particularly, one of the issues, of course, and it goes to Ed's question earlier about how can it affect households. And so, first question really is, how does it layer into which prices move when the exchange rate moves, and then beyond? So, Ben, do you want?
Yeah. So just to begin with, on the rough scale, about 30% of what we consume is imported, either directly or indirectly. So that will give you some idea of the overall level of the effect. That takes quite a while to come through, several years in fact, but there are some areas where you can notice the effects quite quickly, most obviously with things sensitive to the price of oil, so petrol, for example, and also food prices tend to react relatively quickly. We are, of course, starting from a base where real wages are growing pretty strongly, so it would take a pretty big move to turn that around into negative territory. You can see some of the sensitivities of overall inflation in the box at the end of the report.
Can I just clarify my last question? Rather than the broader fiscal response, what do you think of the new Chancellor's specific money for increasing preparedness for a no-deal Brexit. Does that cancel out the risk that you have outlined today? That you've outlined today in terms of a no-deal Brexit?
First is there's an acknowledgement by the government that further steps need to be taken for the country to be prepared, including imports, infrastructure, other aspects, border officers, others. I think there's a recognition, we reference this in the report, that a number of our exporters, particularly small, medium-sized businesses, are not yet set up to export to a third country if Europe becomes a third country as of November 1st for the purposes of trade, EORI numbers, other basic. Well, these are questions for the government. These are questions of financial sector preparedness any day. You can ask us any question. That which we oversee along with the FCA and work with the Treasury, total line of sight into it. Do we know exactly how many border people they need? The progress, we track these things, or we try to track them, but this is fundamentally roles for the government. I think the announcement today is a recognition by the government that more needs to be done, provision of money for those, but in terms of tracking the day-to-day progress, I just direct you over to them.
Last one to Ed. Yep. Thank you.
What do you say, Governor, to those who look at the bank's forecasts, cutting the GDP forecast, 1 in 3 chance of a contraction, and say you're just a load of gloomsters, you're talking the economy down? What's your response to that?
No, I mean, we're recognizing, first thing, we're being very clear that performance in the economy, some of the volatility in the economy is a consequence of Brexit preparations. So these are temporary factors. For example, the second quarter likely to be a flat quarter, could be a little higher, could be a little lower, but a substantial component of the deceleration of the economy from a 0.5 in Q1 to, let's say, flat is because of the unwind of a stock building effect. That doesn't mean rundown of stocks, but an unwind of that, and the fact that a number of auto manufacturers took their downtime, shut their plants literally in April instead of August because they felt that no-deal preparations were not fully there, and that they were going to have downtime if there had been no deal in April. Okay, so that's just, when we say we think there's going to be a flat Q2, it's based on analysis of things, and then we show that. We give our best view of where we expect the economy to go. It's absolutely clear. I think it's extremely difficult to dispute that the level of uncertainty that's affecting businesses has continued to increase. It's also clear that there has been a substantial shortfall in investment as a consequence of that. It's beginning to become clearer that the trade response to lower sterling has begun to fade, in part because of weaker world, but in part also potentially because of the capacity constraints that are a consequence of a few years of not investing in increased capacity because you don't know whether you have the export market. So these consequences are there. We're setting policy in a way that can provide the support for the economy that it needs. We provided a lot of support post-referendum. Fast forward to today, inflation's at 2%. Unemployment's at a 44-year low. We're not saying we delivered all of the latter, but we certainly didn't get in the way of it in the face of some pretty severe headwinds. Thanks.
Okay, thank you all for coming. Hope you get